Hey, welcome back to another State of the Market. I'm Brandon Barnes, and this is Nathan Weinland, both on the Weinland team. We wanted to just give you another update on the current state of the market right now. So, a lot of talk right now about interest rates and what's happening. It seems like we went from 3% to 6% in almost overnight.
Yeah, it just jumped right on us. And I've had agents around here talking about, well, then it must be on its way to 9% and 12%. We're going to see double-digit mortgage rates. It's back to the 80s for us.
Yeah, I don't think we're going back to the 80s. Definitely one of the things that the Fed is definitely using to try and fight inflation, which has been high, is the overnight lending rate. Now, keep in mind the overnight lending rate is not the mortgage lending rate.
Right. So when you hear the Feds are hiking the mortgage, or not the mortgage rates, that's the problem. That's what people hear.
Right.
But when you hear them hiking rates, 75 basis points or something along that line, people automatically equate that to, oh, that must be mortgage rates. As a matter of fact, when it was zero,
to 0%.
No,
Gosh, that's awesome.
no, they didn't. No, they're not. That's the overnight lending rate. It's like 2% now or something, or headed to 2%. So that overnight lending rate, when they raise that, that goes to a cost to banks. That also allows banks to then offer some better rates of return on investments and so forth. So you see people putting more money on deposit.
Right. So the next Fed meeting is scheduled for July 26th and 27th, and it's expected that they're going to probably do anywhere from a half point to a 3/4 point hike. We have that pretty good expectation. Now, what's interesting with those, right, is that ever since 2016, and as you can see on the graph here, is the mortgage rates actually tend to trend downward, but it's a couple months delayed with that.
Yeah, so when the Feds hike rates, we see this consistent pattern of mortgage rates dipping as a result. And of course, that just kind of means that when the Feds are hiking rates, they're doing what they're supposed to be doing as far as trying to get inflation in check or keep inflation in check. So a couple more meetings, one towards the end of this month and then one again in September, and they're expected to jump the basis points again.
Yeah, and so based off the chart that we've seen ever since 2016, we know that perhaps this fall may be a good buying opportunity, and especially if rates kind of drop below that 5% level. So we were hoping that inflation had peaked. When the numbers came out that inflation did not appear to peak, or that the number was significantly higher than what was expected, that's kind of what threw the stock market and a lot of financial markets into a little bit of a tizzy, because that news was unfavorable.
Yes, and markets don't respond well to unexpected news. Like if the Feds hadn't raised it by 3/4% or 75 basis points, if they hadn't done that, the market would have reacted very unfavorably to that.
Right. And so something that we're seeing right now with a lot of mortgages is that people and companies are requiring closing points up front, and that is because...
Well, if you're an investor and you're buying a mortgage, and you're looking at, okay, in 6 months, I know this is going to get refinanced because rates are going to be lower, I'm not going to make any money on that.
Right.
So I'm going to shell out $500,000 in order to purchase this particular mortgage that is going to get refinanced in 6 months. So when they watch the markets, they're looking for those trending signs that say, hey, interest rates are dropping down, therefore, if I'm at that risk, I don't want to lose money from that, or I'm not going to make any money in the next 6 months on those mortgages. So they'll require points up front.
And, looking kind of into the future, that's almost indicative that these investors are anticipating that rates are going to go down.
Yeah.
It's just in the next couple months, hopefully.
Well, yeah, and I think that when you see inflation that peaks up, once we see that peak in inflation, we know that rates will start to drop after that. There's a trailing effect, a couple months or so forth. So when we didn't see that was the peak of inflation on the last numbers, that was one of the things that was like a really impactful statement, because look, inflation has not peaked, therefore we know things are not going to get better for mortgage rates and so forth in the future. And that's, again, maybe a 2-month trailing effect there. So will we see the peak in inflation on the next numbers? We all hope so, because that tells us that dropping mortgage rates are kind of right behind that. And we've already seen some dropping mortgage rates, which is interesting. We were pushing 6% or over 6%, now 5.5%, now it closed out Friday at 5.2%. So are we actually seeing the downside of those mortgage rates? We don't know.
Well, and like I said, it kind of goes back to what the markets are expecting, what they're anticipating, and what a lot of these investors are projecting for the future.
Right. Now, of course, if this is a recession that's coming up and all these indicators are showing this, then that must mean that we're going to have some housing bubble, a housing crunch. Prices are going to be dropping, right? That's what's right around the corner?
Probably not, but stay tuned to the next episode and let you know.
I'm going to nail this. You just watch. You're going to be impressed. You're going to be like, man, it's like he practices all weekend.